You found what you think is a great dividend stock. It may even be a dividend king. A stock with 50 years plus of increasing dividends. You buy it and a few weeks later you're hit with a double whammy. The company announces a dividend cut, which in turn causes the stock price to tank. You've got a dividend disaster on your hands. The question is, could you have predicted this before buying the stock? Were there warning signs? In this video we'll explore how to spot the red flags that could tell you when a dividend stock is about to fall from grace. And we'll do it with a case study on a recent cautionary tale. Welcome to the Money Mentor Minute, where we help you grow your money easier. Now imagine this. You have built a portfolio around a stalwart dividend-paying company like Walgreens Boots Alliance. The investment not only offers potential for capital appreciation but also a regular source of income through dividends. Seems like a sound choice, right? But what happens when this seemingly fail-safe stock falters? Like what recently happened with Walgreens, where dividend payouts were slashed by 48%. You and I, the dividend investors, are left in shock and possibly wondering, what went wrong? With a streak of 48 straight years of increased dividends, the cutting of Walgreens' dividend might be a hard pill to swallow for investors. Let's rewind to see the signs that could have tipped us off on this seismic shift. The first sign can be slowing dividend growth. While dividend stocks love to keep their streaks alive, as was the case with Walgreens, a smaller or modest boost could raise the alarm. Another important factor to keep an eye on is sharply rising dividend yields. When stock prices fall, dividend yields rise. This could be a sign that all is not well. Losses or deteriorating earnings should ring the alarm bells even louder. A company's ability to pay its dividend is directly tied to its earnings. A steady decline in the company's bottom line can put the dividend at risk. And finally, failed restructuring efforts have the potential to pull the rug out from under the dividend box. A stark example of this is when Walgreens attempted to sell off its Boots Pharmacy division but failed, leading to further complications. Though coming to grips with a dramatic drop in dividends may be a tough task for investors, remember, it's crucial to be on the lookout for these signs that could sink your investment portfolio. Watching for slowing dividend growth, rising yields, deteriorating earnings, or failed restructuring can be instrumental in making wise investment decisions. It's okay to assume the best case scenario, but remember to always have plans in place for the worst case scenario, as well. With investments, complacency is not an option, even with the most durable businesses. Investing can be daunting, but remember, knowledge is power. Stay informed and make sure to keep an eye out for these warning signs. Give yourself an edge by subscribing to the Money Mentor Minute, where we'll bring you more of what it takes to help you grow your money easier. So like this video if you found it informative, share it with your investor friends, and let me know in the comments if you've avoided a dividend disaster, and if so, what are your tips? Now check out these other dividend vids to keep you learning what it takes to succeed.